All right, up next we have Seth Holm talking about something pretty bizarre in my opinion. What you got for us today, Seth?
Thanks, Zach. So today I want to talk about negative interest rates. So negative interest rates have been a hot topic in the financial media lately, and there's a good reason for that. So about $15 trillion in global debt now has a negative yield attached to it. That's about 25% of all debt outstanding around the globe. And so this is kind of a mind-boggling concept. It kind of goes against everything we've ever been taught our entire life about finance, how it works.
Right.
Borrowers pay and savers earn. But that's not been the case lately. And so this past week, I read a blog from PIMCO. They're the world's largest bond manager. And they came up with some reasons for what they think is actually causing this global phenomenon here. And they came up with a couple structural factors and a couple cyclical factors. And on the structural side, it really comes down to technology and demographics. So if you think about technology is inherently deflationary. As the economy goes more digital, it just creates a cheaper cost of capital.
Right.
Now the second one is kind of crazy, and it is demographics. And so if you look around the developed world, you have really old populations. They're aging, right? And not only are they aging, but they're living a lot longer. So this is the crazy one where they think the entire time value of money concept may be flipping on its head. And if in your early business school classes, the time value of money basically says $1 today is worth more than $1 tomorrow,
right?
Because people like to consume now.
Right.
Well, the question is, if people, rather than living only 10 years past retirement, now they're going to live 30 or 40 years, they need a lot more savings. So it's creating this supply glut of capital where maybe people are valuing $1 tomorrow more than $1 today, and therefore they're willing to pay when they buy a bond. And so then there's a couple cyclical factors which are also weighing on interest rates around the globe, and those are more simple. Basically, the economy has been slowing down. That's a drag on yields. We had some surprise tariff announcements that weakens the economy further. And then a lot of people think that the Fed is behind the curve. And what that means is basically they raised interest rates too far, too fast, and they're going to have to reverse that.
Oh, wow.
Yeah.
So do you think that that's going to have an impact into the third and fourth quarter? Are we going to see this continue?
Yeah, so the million-dollar question is, will they keep going down? So if you look at the chart here, they peaked up at about 3.5% about a year and a half ago, and they've been coming down really steeply here to 1.74% as of yesterday.
And this is the 10-year.
That's the 10-year bond in the U.S., but we're still a long way. So if you look at Germany and Switzerland, they have negative 1% yields. So the big question everyone's asking is, are the rates in the U.S. going to eventually go negative too? Wow. And for that to happen, I think we would have to have a recession, and the Fed's basically got to cut interest rates all the way back to zero and go back to quantitative easing. But it's a fascinating thing to watch. Because
we don't think that they're going to get that aggressive in the near term, correct?
Well, if we base, Craig Fuller sat up here today and talked about the upturn in the freight markets.
Sure.
We've got a booming consumer, as you've seen with Target and Walmart's reports. However, it's kind of a tug of war between the strong consumer economy and the weak manufacturing and industrial economy.
Right.
So it's really going to depend on, I guess, which one of those wins out will determine the future direction of rates over the next couple quarters.
All right, interesting stuff.